Today, chickens coming home to roost. Property signs for the 20th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at new analysis of my household surveys, the banks not being proactive enough in self-regulation, according to ANZ, and reasons why first-time buyers are stepping back from the housing market, at least at the moment. And we start with the SMH that reported mortgage stress is spiking across key suburban electorates in Sydney and Melbourne, despite record low interest rates, as spiralling property prices leave 2 in 5 households struggling to make ends meet. Electorates that will be pivotal to next year's expected federal election are at the centre of the surge in stress, with up to 70% of households in some areas either left without any spare money after their weekly expenses or forced to use credit to survive. More than 2 in 5 households are now in financial stress due to soaring house prices and mortgages. Research by the University of New South Wales shows that the proportion of households in stress has climbed to 42%. The Reserve Bank says the way negative gearing interacts with the rest of the tax system is contributing to high house prices. In fact, that is based on new analysis of the Digital Finance Analytics household surveys, which I shared with the University of New South Wales. They sliced my postcode data by electorate. House values have been surging over the past few years as the Reserve Bank has cut official interest rates to a record low, and governments have delivered direct support to prospective buyers. Sydney's median house price has reached $1.3 million, a jump of $308,000 over the past year, and in Melbourne it has climbed to $955,000. Regional areas are experiencing price rises beyond 20% per annum. University of New South Wales City Futures Research Centre used my rolling sample of 52,000 households to determine how mortgage and rental stress was affecting the community. The affordability measure used in the research is based on how much residual household income is left after normal expenditure, including on housing. Those with more than 5% left are classified as living within their means. Those left with less than 5% are deemed to be stressed, while those facing a deficit of more than 5% are characterised as severely stressed. This cash flow analysis includes government payments and investment income, plus access to additional credit. In February last year, just under a third of households were struggling with their finances. Now it's at 41.7%. The highest rate of mortgage stress was in the outer Sydney electorate of Wirrawah, with almost 71% of people with a home loan struggling. Other high-stress areas include Greenway in New South Wales at 62.6%, Latrobe at 73.3%, and McEwen in Victoria at 59.2%, and Cowan at 58.7% in Perth. Stress amongst renting households was high in the same electorates, up to 68.5% in Greenway, while other seats including Gilmore at 69.6% and Robertson in New South Wales at 70%, and Casey at 60.2% in Victoria also showed high levels. The research also shows that those with investment properties also face financial pressure. These were mostly inner-city electorates, including Macmahon in Melbourne, where 51.4% of households with investment loans were struggling, and Sydney at 57.5%. Across mortgage holders, renters and investors, the most stressed electorate in the country is Macarthur in Sydney's southwest at 68%. Visiting professorial fellow with the Futures Research Centre, Duncan McLean, said there was a growing sense of anger and concern in key electorates where housing stress was at extreme levels. There's a new politics developing out there, and it's not just about young people struggling to get into the housing market. There's also all these low and middle income earners who simply aren't able to pay their mortgages, he said. The situation facing the housing sector may change national politics over the next 5 to 10 years. Professor McLennan said changes of approach by central banks around the world since the 1970s helped drive up house prices, while governments and their agencies attempted to blame others for their own contribution to the crisis. Central banks say house prices aren't their problem. Governments are saying it's not their mandate, so no one is taking responsibility for what is occurring, he said. And the Reserve Bank Governor Philip Lowe last week acknowledged that low interest rates did contribute to higher house prices, but said there were a range of other factors which could be addressed to deal with the issue. In its submission to a parliamentary inquiry into housing affordability, the bank admitted affordability had fallen the most for lower income households and those renting or looking to buy a home. It said the nation's tax and transfer system encouraged investments in property and discouraged people from selling and moving, which then put upward pressure on prices. The capital gains tax concession, the exclusion of the family home from the age pension means test, the concession tax treatment on inherited family homes all encouraged people to hold on to property even as they got older, putting pressure on the market. The bank said it recognised that ability to deduct legitimate expenses in the course of earning an income, including interest on investment properties. However, the RBA believes that there is a case for considering the tax system in a holistic way, taking into account the interaction of negative gearing with other aspects of the tax system, it said. And of course, Labour has abandoned plans it took to the last election to reduce the capital gains tax concessions and restrict negative gearing. And also last week, the OECD, in its survey of the Australian economy, identified two tax policies that were contributing to higher house prices. It said the current 50% capital gains tax discount was very generous and distorted investment decisions by skewing households to sink money into residential property. Replacing the discount with a cost-based indexation model, which would sharply reduce the amount of gain excluded from any tax, would raise $4.1 billion in revenue over 4 years. And the OECD said negative gearing with the capital gains tax discount effectively led to tax planning and breaches principles of tax neutrality. Tackling structural factors that might skew Australian household balance sheets towards residential property investment could reduce vulnerabilities and improve household well-being, it found. Another option suggested by the OECD was to exclude inherited properties from the capital gains tax discount system. Australia is one of the few nations in the world without an inheritance tax. The OECD said the surge in house prices was also affecting other parts of the economy, and it noted the wealth of many pensioners had been inflated by the strong property market, but this group of people was still being paid the age pension as the family home was excluded from the pension asset tests. Half of the government spending on the age pension currently goes to people with more than $500,000 in assets, it said. But the key point, once again, to understand is that the Reserve Bank and APRA, the two entities that are absolutely responsible for house prices, are throwing smokescreens left, right and centre to blame everybody else but themselves for their bad policies. That must change, and change soon. Elsewhere, Mortgage Business reported that banks are too reliant on regulatory oversight to do what is right for borrowers, the boss of ANZ said. Speaking to investors in the Environmental, Social and Governance briefing on Thursday last week, ANZ Chief Executive Shane Elliott reflected on the state of the current housing and lending market. The Australian and New Zealand economies are holding up well through the pandemic, according to the bank's presentation. However, Mr. Elliott expressed concern around operating pressures for small businesses and higher levels of household debt, particularly for first home buyers. Similar to his counterparts at NAB and Westpac, Mr. Elliott stated housing affordability has become stretched and there is an emerging disparity in housing with an escalation in prices far outpacing the rate of income growth. That impacts first home buyers, the market, and so there isn't this emerging issue here. As a bank and as a prudent lender, we need to be responsible and ensure people are not taking on too much debt, Mr. Elliott said in response to analyst questions. APRA recently recorded a rise in high debt-to-income lending, with its chair Wayne Byers expressing concern. However, the watchdog has said it will not yet commence any action as other risk metrics have decreased. In the current environment, Mr. Elliott stated banks would be reconsidering their risk settings and leaning towards more conservative approaches. Factors up for consideration listed included serviceability numbers and how banks think borrowers' expenses and incomes travel. I imagine that all banks are sitting there thinking about their risk settings at a time like this, with house prices and general uncertainty about the future economic outlook in terms of people's income, the CEO said. I mean, there's a lot to be positive about for the economy, but there's still some risk out there. And while he acknowledged ongoing pressure around the market's share, Mr. Elliott added that the banks should not have to rely on the regulators to do what is right. we do have to have our own risk appetite and sit down and say, what do we think the right DTI numbers are? Or how much are we willing to see in the high loan-to-value ratio lending, etc.? Mr. Elliott said, my view is that there's too much within our industry of outsourcing the problem to regulators, and when they set the level, our job is to go as far, as close to that line as possible, and I don't think that's right. And I think we have to do a better job of working out what's right for us. ANZ's view is that now is the time to tighten lending standards, Mr. Elliott asserted. It's a time to be asking more questions. It's a time to be doing more analysis on borrower capacity. It's a time to be really understanding a borrower's expense profile and their income outlooks, he said. And so, guess what? That may take a bit more time to do and may make the banks a bit uncompetitive in terms of things like turnaround times, but it's still the right thing to do. And I think in the long term, it's actually in the shareholders' interest to do so. ANZ recently saw its loan book total slip by 1% in the month of July to $261.8 billion. It was the only major bank to see falls across both its own occupier and investor portfolios. The bank's book also dipped by $300 million during the June quarter. But Mr. Elliott said the bank has a preference for owner-occupier customers and for helping them pay down their loans and to use offset balances, which has come at a cost. We think it is the right thing to do for the borrower. It is the right thing to do in terms of financial well-being. That comes at a significant cost to our business, the CEO said. You know, if you're trying to maximise the financial outcomes, you're much better off in pushing interest-only loans. But we've made, I think, a purpose-driven decision to say there's a place for interest-only. I accept there's absolutely a place for investors, but our focus is on people who pay principal. And he also acknowledged that the bank had self-confessed to some operational issues. Both Emptor and the Reserve Bank are monitoring the housing and mortgage markets, having discussed what tools they will use if they decided to intervene. Such tools, as listed by RBA Governor Philip Lowe, could include limits on loans with high loan-to-valuation ratios or high debt-to-income in lenders' portfolios. But Mr. Elliott commented the Reserve Bank's choice to maintain cash rates at a record low of 0.1% has also been a contributor to the issues around housing and mortgage lending. Yes, it makes it harder to save for a home, and yes, it encourages increased levels of debt because you can afford it, if you will, because of the lower servicing costs, he said. And that's why I think, and again, it's a think, that's why the Council of Financial Regulators and the RBA made comments about perhaps the need for macroprudential intervention to offset some of those issues. So it's a complex issue. However, he rejected that housing affordability should be folded into the RBA's remit to mirror the mandate of the Reserve Bank of New Zealand. The Kiwi Central Bank also regulates prudential standards, which is covered by APRA in Australia. I think the policy setting in New Zealand, I'm not sure it's appropriate to lift and shift that and say, therefore, the same should be here. Mr. Elliott said, I think the Council of Financial Regulators and I think the regulatory system does have a perspective and a role to play in terms of housing affordability, and I see the way they execute that through the various arms of that regulatory structure. And Australian Broker says that the first home buyer bubble has all but burst in Australia, and the reasons why first home buyers are out of the market are manyfold. First, home buyers have largely fallen victim to the rising property prices, which have made deposits harder to save for, and the end of the subsidy programs that have reduced the total amount that savers needed to raise. On top of that, the return of investors to the market has pushed property prices up further and made those making their first steps on the property ladder increasingly unable to compete with those who have established equity and typically lower loan-to-value ratios. One could see the retreat of first home buyers from the market as a signal that their particular part of the Australian property boom has run its course. As a segment of the property market in Australia, they were most dependent on subsidies such as Home Builder and the First Home Owner Grant. So with the end of most of those government schemes, they were inevitably going to drop out. And then investors have returned to the market in force, which is one of the key reasons why first home buyers are out of the market at the moment. Investors are taking advantage of historically low interest rates, and whilst they are usually liable to pay higher rates than owner-occupiers, they are generally buying with a lower loan-to-value ratio, which can lower rates. Furthermore, those buying a second home, particularly in regional Australia, have been able to take advantage of incredibly low vacancy rates that almost guarantee tenants and returns on investment. As prices rise too, investors are better positioned to flip homes in the market and thus take advantage of opportunities than those without pre-existing equity and lending histories. Bad news for prospective new home owners is that prices are only going in one direction. In truth, one of the key reasons that first home buyers have dropped out of the market is that prices have risen so much that it's hard to see a situation where even if subsidies were upped, they could compete. In popular areas such as Sydney's northern beaches, prices are rising by as much as $10,000 a week, while in regional areas the property market has become so crowded that vacancy rates are hovering at less than 1%. Unless something drastic happens with the cash rate and interest rates, spoiler alert, it won't, then young people can expect to be on the outer for a while longer. Traditionally, one of the best ways to get onto the property ladder was to leave the expensive capital cities and resettle somewhere with more space. Typically, young people had that option available to them when they wanted to start families, and the cohort known as tree changers or sea changers, those who bought their first home in a lifestyle location rather than a city, was well established before the pandemic struck. But now, with work from home firmly established as a feature of the labour market, that has gone into overdrive. More people than ever can work remotely, and thus areas that were once avoiding capital city prices, such as the Central Coast and Wollongong outside of Sydney, and the Macedon Ranges and Geelong outside of Melbourne, have been smashed with huge property price growth. Thus, what was once one of the easiest ways to enter the housing market has been removed. An Australian broker has reported extensively there are essentially two Australias as far as the property market is concerned. There are those who are already on and who can take advantage of rising house prices, improving their equity and low interest rates that allow them to borrow more cheaply, and those who are permanently priced out of the housing market. First home buyers are the ones tasked with bridging this divide, but as leading economist Saul Estlake said a few weeks ago, home ownership rates are likely to fall to the lowest level they have been since 1941, when the 2021 census data is published. No amount of home loan deposit scheme, savings plans, or cutting down on avocado toast can overcome the perfect storm of low interest rates for borrowers, inbuilt equity, and rising property prices. That's why some are saying that housing affordability is stretched, and the worse that they have seen it. If you are looking for reasons why home buyers are dropping out of the market, then you can look no further than that. So, standing back, you can see there's a whole set of implications and consequences of bad policy which are coming home to roost. Problem is, those in charge have no intention of changing direction at the moment, so we're going to see more of the same ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.